We are live. Let me just quickly tweet that and then we can get started. We're live, or join us live. Fantastic. Great. Well, let's dive into it. So first of all, yeah, welcome everybody. We're here for episode 4 of 21 on, the show where we discuss the most important topics in Bitcoin in limited supply of minutes. So we'll just do this 21 minutes to really drill down to the center of a topic. And yeah, of course, show is hosted by Treasury, an emerging Bitcoin treasury company in Europe, backed by Tyler and Cameron Winklevoss, planning to list on Euronext Amsterdam, and yeah, essentially be the first Bitcoin treasury company that's listed on a main exchange in Europe, and orange pill Europe. But today we'll be debating is Bitcoin per share growth Bitcoin yield? And now we know that the main success metric for Bitcoin treasury companies is how fast can they grow Bitcoin per share. This has been the thing that Michael Saylor has been going on about since the start of his journey with strategy, and yeah, so I'll be arguing that that's, of course, that is Bitcoin yield. Alex, on the other hand, very, very great guest for this, will be arguing the opposite. And this is not the first time. Alex is a very seasoned opponent. He's written about this in Forbes. He even went to the Lion's Den right at the Strategy World conference, and I think soon you're going to be in Bitcoin Vegas to kind of make the same case again. But yeah, maybe you want to give a brief intro about yourself, about 2Prime, before we dive into things.
I'm Alexander Bloom. I'm the founder and CEO of 2Prime, which was founded in 2019. I've been working in Bitcoin well before that. We work with institutional holders of Bitcoin and generate returns. We take risk to make a return, which is what everybody has to do with Bitcoin, and we'll discuss today. But work with some of the largest public companies that hold Bitcoin, as well as a lot of kind of Bitcoin OGs and private family offices. We're also one of the largest Bitcoin-backed lenders in the world. So if you send us Bitcoin, we'll lend dollars against it or stable coins. We've done about $3.5 billion of loan originations over the last 2 years. So yeah, that's 2Prime. And I also have a great wife, and I grow a chestnut farm on the side.
Amazing. And yeah, I mean, you wrote that Bitcoin per share growth is not Bitcoin yield. Maybe you just want to run us through your position, in a couple minutes, and then we can really get into it.
Sure. Well, I think I would start by saying I think a great skill that Michael Saylor has is to define the KPIs and metrics by which to measure success in a new field where nobody knows really what to evaluate. And I think this metric of Bitcoin per share and yield is a great example of that. It's also similar, on the stretch product, the STRC is talking about Sharpe ratio. What I think is occurring is, first of all, he's saying, look over here, don't look over here. And he's choosing metrics and words that imply associations with low risk, low volatility assets. But underneath the hood, there's actually a ton of risk. And so, I think first we need to define what the definition of yield is. I think in this broad sense, I have, by my house, there's a lot of wild turkeys. And maybe this year there's 50 wild turkeys, and next year there's 60 wild turkeys. You can say, wow, there's a 20% yield on turkeys, but it has nothing to do with finance or return or what people talk about yield in finance or what the definition is. So if we're just talking about some numerator divided by some denominator, then yeah, everything in the world could be measured in yield. In the financial sense, when people talk about yield, they're talking about compensation for the time value of money. We're not taking directional risk, we're not taking major counterparty risk or management risk or key person risk or credit risk. Yield is being paid, you put money in a treasury, it stays there and I get paid. And if I commit to a longer period of time, I typically get paid for more than for a shorter period of time. That is not what's going on in DATs or treasuries. Let's say I give Michael Saylor or Strategy $1 of my money, I get a share of MicroStrategy, and it depends on the MNAV, but maybe that means they buy, 50 cents of Bitcoin. And so I've taken $1, I've gotten half as much value of Bitcoin because the stock is trading above the value of the assets. And then now over time you go, oh wow, we took your 50 cents of Bitcoin and now it's 60 cents of Bitcoin. But I could have just had $1 of Bitcoin from the start. And so yes, have you increased my Bitcoin per share from 50 cents to 60 cents or whatever the ratio is? Yes, you have. But in the sense of why people would actually own this, it wouldn't be to take $1, turn it into 50 cents, and then grow it into 60 cents. The reason people are really buying it is that either they want leverage to Bitcoin, so I want a levered beta to Bitcoin, or I just want dollar returns, and I don't actually care about the amount of Bitcoin that I have. And so in the first case, like if it is just leverage to Bitcoin, you can go on Hyperliquid, or if you're institutional, you can work with counterparties that will just sell you futures or options to get you that leverage in a way that doesn't have management risk. It doesn't have the fees and overhead of a operating business on public markets. It's not subject to all the regulatory mess and risks and issues of a public company, and you could still have that same beta leverage. And actually, if you look at Strategy stock over the last year, it's going up less than Bitcoin and going down more quickly than Bitcoin. And so it's like negative beta leverage recently. If you want,
I mean, that's a very specific time window, I would say. But
sure. I mean, the whole thing's only been going on a few years, which is part of the point. Is there's really not statistically significant, meaningful data for any of this because it's all brand new and being made up. So when you start talking about yield or you start talking about Sharpe ratio, these are things that take long and thorough data sets to really even make a meaningful, statistically significant argument. But to go back, I'll get through this somewhat quickly. If you want dollar returns, then nobody cares about the Bitcoin per share or the yield. They care about, is the stock going up or down? And in the case of Strategy, at least over the last year, it's not going up as much as Bitcoin, and it's going down more than Bitcoin. And so what you really have is something akin to like the Grayscale Trust before it was an ETF, which was you send in money, the trust buys Bitcoin, and you get a share of something, but there is no way to pull the Bitcoin out. It is a black hole of Bitcoin. And so if you want to get out of the position, you can't redeem back to Strategy or Grayscale in the past for your Bitcoin. You can only sell on a secondary market. And so what ends up happening is that you're not subject, the price of Bitcoin or the value of MicroStrategy, that is not what drives the price of your shares. It's the supply and demand dynamics of MicroStrategy shares itself, which maybe there's some kind of implied connection to the Bitcoin, but actually you as a shareholder have as a minor shareholder, have no claim on that Bitcoin. You have no influence over what happens with the Bitcoin, and there's really no direct connection to it. So I would say that, these treasuries, and this isn't bad or good, they're almost the exact opposite of Bitcoin. They have unlimited shares, they have inconsistent monetary policy, they have key man or leadership risk, government and regulatory risk, management costs and overhead. There's no anonymity if you're a holder of it, which is fine. There's actually active management of assets is a way that may outperform, it may underperform, but trying to imply that it's the same thing as Bitcoin or like some yield, low risk version to accumulate Bitcoin is just not the case. And so I think there's nothing wrong with using Strategy or your company or others to try to gain more money or get higher leverage than it is to just holding Bitcoin itself. But you've got to understand it's not, yield implies this super safe, low risk thing, and that is not at all what you're getting. What you're getting is a maybe alpha product or an actively managed solution to Bitcoin exposure, which comes with risks and upside. So that is my thought.
Yeah, I think maybe to push back, at least a little bit, right, on maybe a lot of the things that you said, right. I think, well, first of all, like the grayscale analogy is, of course, like maybe an attractive one, but one that obviously doesn't hold, right. I mean, grayscale is like a closed-end fund, right, that doesn't have any of the levers that a DAT has, right, or a Bitcoin treasury company, right. It can't issue new shares, right. There's no sort of way with that the management can essentially control how it trades, right. And there's no sort of way that there's no M&A, right. There's no way that it can be redeemed in any way, right. So that was very much kind of this pool of capital, of Bitcoin capital that was sitting there, waiting to be turned into an ETF. But I think with Bitcoin treasury companies, that's not what we're seeing, right? Like the big Bitcoin treasuries are, kind of trading around NAV or, quite strongly, bounced off of that. And then maybe like the second point, right, which is that, you're sort of saying that DATs or Bitcoin treasury companies are equity risk, sold as BTC or sold as BTC yield. I would push back there as like, if you can access Bitcoin, then by all means you should, right? You should buy Bitcoin. Like I think that's what we both very strongly agree about. But 99% of capital in the world can't allocate to Bitcoin, right? It's allocated exclusively to stocks and to debt, right, or to bonds. And if that's your the profile of things you can invest in, then a Bitcoin treasury company makes a lot of sense. And then when it comes to the the point about yield, right, or the point about Bitcoin yield, any company that issues new shares, right, is essentially going to the market, raising capital, and investing that capital into something that's accretive to shareholders, right? So if I'm running Berkshire Hathaway, or if I'm running any public company and I issue stock to invest and do something productive for my shareholders, then I'm effectively generating yield or generating returns for them, right? And in this case, we just have this very unique opportunity, kind of once in a lifetime opportunity to do that with Bitcoin, right? Because it's still very early. Bitcoin is about 10 times smaller or more than the market cap of gold. So there's just a very clear gap to close there, and we can use these instruments to do that.
Well, I would say, first to say 99% of people can't access Bitcoin directly. Well, I'd say
I would say 99% of capital, 99% of capital in the world.
Right. The bulk of that is in Europe and the US, and what they can access are Bitcoin ETFs, which give you pretty much proxy exposure with much less active management risk or risk of mistakes. Or like, imagine like if Michael Saylor dies, what happens to the price of MicroStrategy or the price of Bitcoin? It's not good. And so I'm just betting almost like my money that this one guy's not going to die. He's going to die at some point. And so I think there's all sorts of risks you're taking on that an ETF, for example, wouldn't have, or you could buy a levered ETF product, at least in the US. So of that 99%, probably 60, 70, 80% of it has access at least to ETFs. And then to your other point that you're saying, Berkshire Hathaway invests money into things and tries to grow returns. And you said, they make a yield or a return, but that's my whole point is, yes, they make a return. Berkshire Hathaway does not claim to make a yield on your investment. And so my whole point is just that yield implies this level of safety and predictability that no one would think you would get from Berkshire Hathaway. And then I forget, what was your first point? I had something to say about that too.
About Grayscale.
Oh, no, there's something else. But in the case of Grayscale, I think the analogy still does hold in the sense that you cannot go to Strategy, say, here are my shares back. I want Bitcoin back now. I want my Bitcoin per share.
You could do that if you're the majority of investors, right?
Sure, if you're a multi-billionaire, you can do that. But if you're not a multi-billionaire that's going to control the company, then no, you can't do that.
Okay.
There's one other point you made, but I missed it now.
Yeah, maybe to prod into one other thing, right? Which is that the kind of thing you outlined in the Forbes article, right, was like, okay, Bitcoin per share growth. You sort of like almost labeled it as like a Ponzi adjacent to some extent. But then in the sort of strategy world talk that you gave, you actually said that Bitcoin per share growth is real, right? And it's a compounding thing. And that it actually should deserve like an equity premium, right? So how do you reconcile those two positions?
Sure. What I said was a little bit different. First, that is Bitcoin per share growth real in the sense that you can measure a ratio of shares of a company to the amount of Bitcoin it holds? Yes, of course. What it doesn't do is guarantee that the price of anything is going to go up. And this reminds me, the other point you made was that Right now, MNAVs of treasury companies are at about 1-to-1 with the underlyings. And so, sure, that's true currently, but it was at 2x, 3x, 5x. So you have a trajectory. We may just be at a point of time where it's 1-to-1. And I would think that if you have Bitcoin in a company, but it has a bunch of extra fees and overhead, the natural place it should be is at a discount to the assets because it's assets plus liabilities and expenses. What I was saying at Strategy World was, yes, there are, you can measure Bitcoin per share, but what I was saying is if you could actually generate new Bitcoin, not through this structure of selling shares to buy Bitcoin in this loop, that's pretty much not possible currently with MNAVs at 1 or below 1. But you could do stuff like what we do for clients, which is delta neutral arbitrage strategies or low risk lending strategies that actually means, oh, somebody paid me Bitcoin for some risk on activity. Then yeah, if you can show, hey, I can compound my Bitcoin 3 or 4% a year with very predictable low volatility trading strategies or credit strategies, then that's income at that point. And so you would think, yeah, that should have some multiple in public markets if public markets believe that it's a repeatable activity.
Right, which is very much proven to be, right? With STRC and all the sort of the big wave of preferreds that are coming to market currently. Okay, so your kind of central point, and maybe that also kind of really ties into what 2 Prime does, right? Is that it's kind of a definition question, right? So you're saying that Bitcoin per share growth, is not Bitcoin yield in kind of like the definition of what you define, right, as yield, which is rather
like financial markets,
giving your Bitcoin to 2 Prime and engaging in the yield generating activity there.
Well, we wouldn't call it yield generating. We would call it alpha generating or return generating risk behavior. What you can do with Bitcoin is you can take some risks. You can take delta risk. You could take counterparty risks. You could take some different kinds of trading risks or credit risks, and you can get paid for that risk. And my whole point is just we would never call it yield because that implies there's some kind of risk-free rate on Bitcoin. We would call it a alpha strategy or a risk reward strategy, and that is what is happening in treasury companies as well. I think the problem is I think it's a bit pernicious to call it yield. Most people are retail that don't really have the nuance to understand, but they hear the word yield, they go, that feels safe. And actually, like if you're a holder of Strategy the last year or Metaplanet the last year, the Bitcoin per share is up and you're down 3x, 4x due to a compression of MNAV, which is natural and what you would expect to happen. And so my worry is that retail people don't really know what they're signing up for, and language is being used that puts them at severe risk.
I see. And maybe to as we're kind of coming to the 21-minute mark, what would you define as Bitcoin yield?
I would say it does not exist. I would say the risk-free rate, if you really want to return on Bitcoin, I mean, if you want to hold Bitcoin safely, for most people, you need to put it with a qualified custodian or some kind of counterparty. If you want to grow that Bitcoin, you would pay a company like mine 1 or 2% management fee. So I'd say the risk-free return on Bitcoin is probably negative 1.5 to 2% is what you can get by protecting the Bitcoin in custody and hiring a manager to grow it. And then it's their job to outpace those costs to make it. And I would say in a public company, actually, there's the overhead, the lawyers, the auditors, the admin, the reporting. So there's a whole other layer of expenses even beyond that. And so there is no yield on Bitcoin. There's just risks you can take to make a return.
Okay, great. Well, I think that's a very strong, to go slowly, but yeah, I think maybe to sort of summarize, the points that we made, right? If you want, outright BTC and BTC income, generating activity, then then by all means, those are the strategies that you can pursue, right? Or those are the strategies that, say, 2 Prime offers and other participants in the market. If you want, say, maximum, right, BTC accumulation kind of per unit of equity, then with of course like the reflexivity risk, then there are the Bitcoin treasury companies, and whether, I suppose, it's called Bitcoin yield, Bitcoin income, or something else. There are many ways to define it, or many ways to there are many names we can give it. Do you think that's a fair summary?
Well, I guess I would say there's not many names we can give it. It's what yield is not one of the names I think we can give it, but there are other things that are more accurate. I would say yes, if you want active management and you want more risk and potentially more reward or downside, it may make sense to own a treasury, but there's a lot of diligence about the management company or other risk factors, could be regulatory, could be political, all sorts of things that you could look into. You could get more upside than just holding Bitcoin. And yeah, so it's not like I'm not saying one's bad and the other's good. It's just having clear eyes about what you're getting exposure to. And we're wrapping up here, but just want to say I think it's so great to talk about this stuff, and I really admire and appreciate your willingness to get on a call about it. So it's been a pleasure.
Yeah, that's great. That's great. Maybe a couple final words, like where can people find you to learn more?
You can email at info@2prime.com, or we're on Twitter at 2_prime. And yeah, we're happy to speak with whoever wants to talk.
Amazing. And then yeah, make sure to follow the Treasury account for more updates about Bitcoin and Bitcoin treasuries in Europe. And yeah, we'll be back in 2 weeks with another episode like this. Next week we will be back with King's Treasury Forum, where we will unpack a new idea with a new guest. And yeah, we're right at the 21-minute mark. So yeah, see you guys next week, same time and same place. Alex, it was a pleasure, and yeah, look forward to reconnecting soon and talking more about this.
Likewise, thank you.